Good morning, everybody, and welcome to Series 2 of Crystal Clear Complex Cases. I'm Dan Morris, Key Account Director at Crystal Specialist Finance, and as always, I'm joined by two of the industry's heavyweights, the best in the field at what they do. We've got Roger Morris. Oh, God, what's your new title? Forgot about that, yeah, bloody hell. From One Savings Bank, so I'll let you introduce that. And then we've got the tax wizard, which is John McCaffery, tax partner from Alexander and Co. Good morning, gents. How are we doing?
Very well. Good morning.
Morning, Dan. Morning, everybody. Thanks for taking the time to log on and listen this morning.
That's it. So what's in store for you today? Same as always, if you've been on previously, it's anything really, anything topical that you want to discuss. We're going to be discussing a little bit around ESG changes that may or may not be coming in. Limited company buy-to-lets, any tax questions, anything you want to discuss really. So the beauty of these webinars are we discuss what you guys want to discuss, or any questions, whether it's product related, sector, market, tax, you name it, we'll discuss it really. We'll go on for about an hour, and yeah, we'll see the webinar goes. So it's been nearly 2 months now since the last webinar, which seems to be absolutely flying. We're into February, soon to be into March, and then Q2, and it's going crazy. And how have you found the start of the year, guys? How's it been? I'm guessing, John, you'll have been absolutely mad busy, but Rog, what about yourself from a lender point of view?
Yeah, I mean, I had a change in role over the Christmas period and moved now to Group Lending Engagement Director. So what does that mean?
Yeah, what does that
lenders mean? The OSB group of lenders is 100% reliant on the intermediary. So we don't sort of go direct and try and compete against you. We need the intermediary, Dan. So right at the heart of our three primary lending brands, Precise, Kent and Interbay, they wanted a broker's viewpoint. They want the broker's voice internally as well as externally. So I took on, I think, what is a very important role. So it's been able to listen to feedback on servicing and queries and problems and those messages. So, I reach out to anybody listening that if you think we're doing a great job, let me know. If you think we're doing a poor job, let me know. And if you've got suggestions. So I just think we're going to go on that journey, Dan, and we've already seen some good improvements. So good, positive start for us at the beginning of the year. And I think a great commitment, Dan, to the intermediary channel. What about you? How's your year started off at Crystal?
Do you know what? It's been really, really busy, I'll be honest. So there's no particular sector, region or anything like that which has came out stronger really. We've got a really good kind of product mix in terms of what people are looking for. We've seen a huge uplift in bridging this year, which has been quite interesting really, because there's nothing going on where I suppose we'd see a trend for that. So it's not as if it's last year when it was the stamp duty holiday, so we were looking to obviously extend and complete quickly. So yeah, we've seen a real blend of products from all over the country in terms of bridging, commercial development, buy-to-let, resi, you name it. So yeah, we've had a really, really strong start. We're getting busier and busier, and we're hoping it's going to be a really good year. And this is the first, I suppose, normal year that we're going to see as a market really, whether it's from a lender's point of view or a broker's point of view, because there's no stamp duty holidays, there's touch wood, there's no COVID or anything like that. So it's the first normal year in a few years, so we'll see where the market looks. But as it stands, we've started strong, and I know a lot of brokers have started strong and have been again inundated and are not sat twiddling the thumbs looking for the next deal, which is brilliant.
Yeah,
what about yourself, John?
Me, start each year as mad as ever. So January is always a fun time in the tax world. The government has very kindly extended it to February this year. So if there's anybody out there who hasn't got their tax return in at the moment, you still have time to do so without getting a penalty. There will be some interest. 2022, it's funny to talk about normal year because it may well be the last one in terms of tax for a while as well. Our allowances have all been frozen for a few years. You've got company registration tax going up next year. And we've got the on-off, won't we bring in a national insurance and dividend tax rise in the next few months. So interesting few months ahead, believe it or not.
Yeah, well, it's always interesting in what you do, isn't it?
Oh, always.
No, it's brilliant. It's good to have you on here again, because again, I know you've added a lot of value to a lot of people that have been on these webinars. So thank you for coming on, because you really do make them what they are. And obviously, Roger, you do as well, without you getting upset about that. So yeah, no, but it's brilliant. So I know we've there's a few things that we wanted to discuss today. So apologies for that. Rod, do you want to go through? I suppose there's a lot of words around at the moment in terms of the changes that are coming in, the EPC ratings, and it's going to C, and people are looking to start getting things in place. But what are your thoughts in terms of where we're at in, I suppose, with the EPC changes and the ESG, etc.? So I know you're going to be an expert in this particular area, so let's hear your thoughts and where you see it going.
Right, what I'll do, guys, is try and just give you an up-to-date position on ESG. So this whole green energy, the social side and the governance side. But let's take really what matters, I think, initially to your day-to-day business activity, guys. And I think the first thing coming down the tracks that I would get you to update and upskill on is how legislation could potentially affect landlords with the potential impending rise of the EPC rating on a buy-to-let. Now, most of our glorious buy-to-let lenders have gone out in the press and stated, I think, inaccurate facts when they're saying that legislation will now come in from April 2025, stating a buy-to-let property which is issuing a new tenancy will need to have a C rating. And that's absolutely incorrect. It was a consultation that suggested that from April 2025, that a buy-to-let property would have potentially a C rating. As it stands at the moment, this particular amendment to the energy bill that came into law in 2007 is being considered, and it's had the second reading of the bill in the House of Lords. And we are expecting some form of update in the spring, but nobody actually knows. It was supposed to be the spring of last year, Dan. So what do we think is going to happen? If I was to have a guess, it's going to be at least April 2026 before this new legislation comes in for new tenancies. And I do think for existing tenancies, the deadline will stay at April 2028. Secondly, it's about understanding what a C rating means. So most buy-to-lets will have an E or a D rating, and specifically the older properties. If it's a new build property, you're not concerned. So let's look at the most affected category, which is a Victorian property. A Victorian property that is currently on an E, possibly a D rating. A number of my D-rated properties, Dan, only need 4 to 5 more points to get to a C. Just 4 or 5 more points. Doesn't sound like much, does it? But it actually is quite a significant amount of work. So what you need to do, and the word, if you haven't heard it before, it's called a retrofit. And there's been an awful lot of study done on a property in regards to a retrofit. And there's a piece of legislation that social housing councils and government are trying to have, which is like the kite mark for a properly retrofitted property, is called PAS 2035. So let's make it quite simple. A landlord has a Victorian property, and the current cap's about £3,500 on spend before you don't have to spend any more. We think that's going to be raised, we think, to guess, to about 10,000. What that means is a landlord would have to spend £10,000 and then they could go for an exemption, because to do a retrofit on a Victorian property, the estimated costs with the current technology at the moment could be as much as of about £32,000. And that cost will come down dramatically over a period of time. As it stands, and we'll go live to John soon, but not yet, John, is about how that would be potentially made, because at the moment, the vast majority of that isn't currently within your allowable deductions on your tax return. It goes against when you sell a property, and John might tell me off for this, but your capital gains allowance. But statistically, you spend £32,000 on a property at the moment, you will get zero increase in value. If anything, you could reduce the value. And that's because the one thing you're statistically going to have to do to get to a C rating is do internal or external wall insulation. Now, in a Victorian property, if next door's either side on a terrace, you don't want to do external wall insulation because it'll ruin the external appearance of a Victorian property, which is one of their USPs. You'd have to do it internally. But then that would have a detrimental effect on the coving, cornices, and the internal structure of that property. You may have to remove kitchens and bathrooms to be able to do that correctly. So there's a lot of work. And then John, we hear an awful lot about air source heat pumps. Air source heat pumps, guys, have you heard of them? By putting an air source heat pump in, apparently it's great for the improvements to your property, but it will actually reduce your rating, say from a D to an E, because when it comes to energy efficiency, they're not as effective as a gas boiler, which apparently they're going to stop or outlaw once we've done our hydrogen review in 2026. But let's just say your landlord puts an air source heat pump in, which technically at the moment would not be something I would advise to do because this one major reason. An air source heat pump stores water by heating water from the atmosphere in a tank, and it stores it about 50 to 55 degrees. Most air source heat pumps, the max temperature is 55 degrees. Now you say, what's wrong with that, Rog? Well, landlords are governed by more legislation than a residential homeowner. And there's a piece of legislation of which every landlord must abide to, and that's the Legionnaire's disease legislation. What that means is water must, and if stored, has to be kept at least 60 degrees. So if you put an air source heat pump into a house, it's great. If it's a buy-to-let, you can't rent it out. But we are seeing technology like microwave boilers come through. And we're having seen a combination of shared ground source heat pumps. And the big thing is about understanding what the implications are. So a summary, wait until the rules are defined and explained and implemented in law. Understand what the rules dictate and what a landlord can do. And then it's about understanding what technology is available. So John, let me ask you a question first, and I'll come back to you, Dan, on products. John, what would you say to a landlord at the moment who's looking to maybe spend 20 or 30,000 pounds on a property of which he'll see no capital growth? What would your generalistic tax advice be?
At the moment, as you pointed out, it's not yet law, and as a result of it not yet being law, there's absolutely no tax relief available for that expenditure or additional tax relief available. If you're making structural changes to a property, you don't get tax relief for it. It's added to the cost of the property, and as you say, it's only tax deductible if, as and when you sell it. There may be some elements that you would classify as a repair, so replacing like for like with modern equivalents, that would get you some tax relief. But as it stands, you're having a very large outlay for which you will not get any tax benefit.
John, very wise words. So guys, in summary, as a landlord myself who's got a significant amount of Victorian properties, I can't and are unable to do anything until the law is set, because there's no point disturbing your tenants. Remember, this is somebody's home. You might own it, but it is somebody's home. And we do have a social responsibility as part of ESG to ensure that approximately 1.1 million families in Victorian properties under private landlords are not just evicted willy-nilly. So when it comes to lender product selection, Dan, what are you finding on a day-to-day basis at Crystal? Are you getting flooded with the requirements of green products?
I think first and foremost, just to touch back on what you just said there, you've done your homework a little bit on that subject. And a lot of people are, well, not even a lot of people are considering it or thinking about it yet, but I think the message that you're basically saying, the both of you, is stay put, don't make any kind of rash decisions in terms of speaking to your clients and look into the future yet, because we really don't know what it holds, do we? As much as you could gear up and get this information in your toolbox and learn from the likes of yourselves, John, etc., and have something set to go when the announcement, or if the announcement is made, so to speak. But yeah, I mean, from our point of view, have we had many people come to us for green products? A handful, if I'm honest with you. It's not really on people's radars at the moment, and even those people that are looking for green products and then potentially trying to get ahead of the curve and make the changes to get them up to that C rating or above, when you look at the difference between a standard product and a green product, it's negligible. So it's not actually going to be beneficial for them to carry out the works because it's not cost effective from a mortgage point of view. Yeah, it's brilliant that you are thinking ahead of the curve and saying, right, I want to get ahead of this, not fixed for 5 years now on a standard product, because actually there could be ERCs that are having to be paid in 3 years' time if the changes were to come in. But I think at the moment it's not really on people's agenda and radar. And certainly if it is, when we're looking at the cost options and the I suppose the difference from a monthly payment example and interest rates from normal products to green products, it's negligible. So it's actually putting people off because there's not a huge incentive there to actually go for these green products. I mean, yeah, people are coming to us if they're buying a new build property or have a new build property or something that is seenable. Absolutely, people are asking for the green options, but still it's not on people's radars to look at doing this remedial work to get it up to par, really. I mean, that's going to change obviously over the future when hopefully lenders come in with a lot better products and incentives for these particular clients to get them up to green. But then again, you're kind of forgetting about those that haven't been able to get them up to the C rating and above. And I suppose it's a bit of a slap in the face for them, and it's a bit of a, well, we're not going to start looking after you now. We're going to look after these clients which are on A, B, and C ratings. So I think we need to look at kind of both ends of the curve, really. So I mean, what have you got any plans at the moment? You probably won't tell us, but about bringing in a green range or any kind of benefits for those that are C or above?
I can't speak at the moment for the OSB group, but let me speak as a landlord and let me speak as somebody with the social conscience. When lenders bring out products attracting A rated with the cheapest rates, then B and then C, a greenwashing in the sense of what they want to try and do, Dan, is to get as many A, Bs and Cs to get the boot to meet their overall mortgage book, Dan, to meet the government's requirements for 2030. So what they're doing is trying to attract the elite and leave back behind those Victorian properties and those properties prior to 1939. Now, if lenders have been very happy being able to take all types of property types to a date now, I think it's wrong where we suddenly create property prisoners and we turn the backs on those landlords that we've made money off for years. And I think lenders need to come up with a comprehensive solution of where there are not property prisoners, of where we have products and incentives and solutions for all landlords who have an ESG. Remember, it's energy, social and governances. So focusing on your social side, are you creating property prisoners where those landlords can go nowhere, that they're left out on their own? That doesn't feel very social. Your governance is about doing all the right things. So things like if you've got a landlord comes to us today, and we've had this product for a number of years now, and Dan, maybe you can explain it more in a second, but it comes about our refurb buy-to-let or retrofit buy-to-let. I always promote it is where you currently find a property with an F or a G rating and you want to refurb, tart and turn and create it into, say, an E rating, then we have that product that I know you'd heavily promote and you're experts on. And what we're saying now is if a customer wants to do a retrofit, why not then take into account the latest changes once the kitchen and bathroom out to be able to put that wall insulation could be done for as little as £4,000, but have a big effect on the increase in the value of the property. I think lenders cannot create ranges that create property prisoners and the elite, but it's about looking at real valued solutions. So when it comes to retrofitting, refurb, buy-to-let, Dan, and just bridging, which can be used to improve the quality of a property, I know this is an area that you can offer that service in.
Yeah, no, absolutely. And we're seeing a lot of it, especially at the moment. Again, on the bridging side of things, the auction properties or even them properties which people are trying to buy on for a buy-to-let, for example, but it's actually an F rating because it needs a lot of work doing. Obviously, lenders now will not lend on the basis that it's above an E. So we're seeing a lot of these clients use that product because it's a really good product, refurb it, and then straight onto a buy-to-let product, no messing about. So they're flying off the shelves, and it kind of ties in with a question that we've been asked in the question box, which is from an anonymous attendee, but given the rise of green mortgage products, could you also see maybe green bridging becoming a thing? For example, cheaper rates based on the sole incentives or purpose of EPC improvement. It's an interesting question, that.
I think anything has to be thought through about what we're trying to incentivize the landlord to do. That if a landlord can be incentivized to take what is potentially could be an unlettable property in the future, retrofit it and make it efficient, particularly for Victorian for another 100 years, then we have to look at different ways to incentivize a landlord to do that. And I really think that's very important. You know, when I first read the rules, you're just thinking the properties in the North, Dan, where we live, you would argue, you know, 50, 60,000 property in Teesside, you're not going to spend 30,000 on it. As soon as that law comes in, there's no point spending 10 on it because you've wasted 10,000. You just might as well sell. But you're not just selling a property, you're evicting a family. And where will that family go? They can't just go and rent somewhere else locally because the law's in. So if they live in an area of Middlesbrough, for them to find a property to rent, they have to move away from that Victorian estate where all the family, friends and children go to school and go somewhere else. And there's a huge upheaval in families, and that will affect the children's education, the friendship and relationships break down, and the social structure that families have with parents and grandparents when it comes to babysitting. So I just think we've got to wait for the facts to come out with this, and we've got to then challenge ourselves with the ESG message, which isn't just purely try and grab as much of the primary A, B and C properties, but help every landlord with a well thought out product, because the social and governance inside as a broker, as a lender, become important. John, have you got any points on this? Because I know it's not a tax related question, but
no, I agree with what you're saying. You do need to know the facts, and I mean tax is very legally based. So until you have the law in place, you can't do anything particularly about it. There are some environmentally favourable tax rules in place at the moment. They generally don't benefit residential landlords. One of the things that may happen is that grants might be given to certain landlords, homeowners, that kind of thing. And the key tax point on that is if you are paid a grant, you've not paid for the service or the product, so you aren't getting the tax relief, which some people have difficulty understanding because it's basically not your money. In terms of commercial property or property held by companies, there's a particular relief, and it doesn't relate to the EPC particularly, but there's a particular relief known as land remediation relief. So where you are cleaning up environmental damage in terms of land or waterways, there is enhanced tax relief available. Commercial property owners can also get something called first year allowances on certain environmentally approved products. So first year allowance is basically 100% tax relief in the year of purchase on certain assets, but there's annual investment allowances and 100% capital allowances anyway, so that's a limited use. So no, I would absolutely. The other thing is kind of like, as you say, it's if you start making changes now and they don't comply with the eventual laws, one, you have to spend more money later anyway. Two, you may be doing something whereby you think you're going to get a set of relief, or you're incurring expenditure before potential tax reliefs are known about, and they won't apply tax reliefs retrospectively. So I very much think it's hold fire on this. Absolutely hold fire on this.
Yeah, don't get ahead of the curve and ultimately just wait until the actual announcement and then go from there, because there's going to be some sort of relief, isn't there? There has to be a cash, in theory, financial incentive to.
I don't know. The Osborne thing was brought in as a political move. So we're talking about the stamp duty and the lack of interest relief, because the government has a housing problem, and there is a mindset within the government that thinks that if they can get residential landlords to sell up, housing stock is freed up for purchase for the first-time buyer.
It just, well, doesn't work like that, does it? Because
no, it doesn't work like that, but that doesn't mean the civil servant doesn't think it works like that. And it would be, it's interesting is the wrong word, because I appreciate how many lives it affects, but it will be interesting to see the approach they take as to whether they're actually waiting to free up this housing stock back into the market and take it out of residential landlord hands.
I mean, the only problem I'd say, John, is at the moment there's a huge underserved capacity for housing that local authorities are desperate to try and overcome, where and there's a huge bill of those families in temporary accommodation, which is substantially more expensive. And I'm sure somebody maybe worth the bean counting out with that. But John, also we've got a new housing minister who comes from up north, Leeds way, who's got one large buy-to-let. So he has a much different view. So it could be a different change within the approach of the government. We do have to do something around ESG. We've got the climate change challenge. But for the properties in the north, it's not worth the investment of 10 or 30,000 as it stands at the moment, without any increase in equity position. And if you haven't got that money, you can't borrow it, because no one's going to lend it to you because there's not an increase in value. And then what do you do with a tenant for 2 or 3 months? Where do you put them? You'd be responsible for housing them. And it's not just the cost, where do you put them? So I think there's a lot of challenges to come. And I think what will be interesting, Dan, is when the rules do come solidified and we understand that, by doing a specific webinar just on that. And maybe, Dave, if we pick that up in the marketing over the next couple of months, because there will be more and more speculation flow through on this. And I think John's right about the challenges. If the government were to suddenly give tax breaks to landlords, oh God, they are looking after the rich. But it's about trying to see which way that will go. The technology is not there. So in other words, you can't use air source heat pumps. We haven't got a decision yet on our hydrogen boilers, which are supposed to be coming in 2026, which is a year after they were going to impose these EPC changes. At the moment, if anybody's ever heard about hydrogen boilers, a hydrogen boiler works fundamentally the same as a gas boiler. Now, the older ones might remember the Hindenburg, which is this big balloon, and it blew up. The reason being is, if we remember from physics at school, the gas particles of a hydrogen is far smaller than it is on your general household gas, far smaller. And what that makes is the ability for those particles to filter out into the environment becomes far easier. So the infrastructure of our gas supply needs to be very comprehensive. So there's tests going on at the moment. Baxi, I think, are doing it in Gateshead at the moment, Dan, on 200 houses. But even yet, they haven't had the confidence to increase the amount of hydrogen within that gas system, because if it goes wrong, your house blows up. So there's that side. There's the microwave technology, which is accelerating fast, but a lot of us are negative about microwaves. You want this massive microwave pump to heat your water supply. But also, Dan, take where you live in Teesside. Teesside is the greenest part of the UK now. It's 100% powered by renewable energy because of the large wind farms out there. So as long as the energy that we're heating our houses comes from non-carbon emission, the ability to be able to change our approach becomes constantly evolving and changing. But I do find this a really good debate. Is there any more questions that have come through? I can't see them.
Yeah, no, there is. I mean, do you know what? Remember Ask Jeeves, that search engine? It's literally like you now. It's like you've swallowed Google. Genuinely is. You've done a lot of research on it, as you always do. Yeah, no, there's a few. I mean, well, I'll close that one off from the anonymous person around the green mortgage products and green bridging. Do you know what? If that's where the market goes, green bridging probably will become a thing. It will be. There'll be some sort of battle, again, as there always is with lenders on products, and there may not be cheaper pricing than what there is at the moment, because bridging is priced really, really cheap. as it stands, with the rate starting from 0.4 something, but there may be an incentive there, a cash back once it's done and up to standard, or something like that. So I believe there will be, in my opinion, some sort of incentive to do that, but what and when, who knows. Again, it will be obviously tailored around when this is brought live as such. We've got another one. So John, this is one for yourself. Phil, Torfield, thank you for this. So regarding beneficial ownership, can the declaration of trust in Form 17 be done at any time or at the point of purchase only?
It can be done at any time, but if you're doing the declaration of trust and you have a split ownership, make sure you do the Form 17 as soon as possible thereafter, because from the revenue's point of view, it is only effective, the split is only effective at the point at which you do the Form 17.
And can I just say, I delayed sending my form in because of a mix-up between many things by literally about 4 months, and it cost me about 4,000 extra in tax. That this is just me personally. That form is not a form for your accountant to do, anyone to do. You, if it's your house and you've got it set up where you want to be taxed on an equal basis, it's you as the applicants can go online and it's an electronic form, it's data stamped, and you do not start getting that disproportion of how the income is moved until that form's filled out. And then you've got 60 days to send it in through your accountant, most likely, John. But I can't emphasize enough, do that form and make sure you do it the day that either you've registered the property and also get that trust document as registered on Land Reg under a Schedule A notification. So you kind of need all that evidence, don't you? And I know Alexander's can organise all that. They can organise the trust document. They will make sure it's registered on the Land Reg. So if you've got more than one property, it'll all be done for you through that service.
We will get you a lawyer to do that. We don't do that.
Yeah. No, but what I'm saying is it's a seamless service that you would offer.
We can do
you
that.
Don't have to go and phone a lawyer.
No. We've got a couple of lawyers that we would work with on that, and we are kept informed and we know exactly what's going on. The other thing I would remind people on that is, if you think you've got unequal ownership in a property, the revenue default position is that no matter what that unequal ownership is, if you're husband and wife, you will be taxed 50-50, even if the ownership is 199. So you have to do the Form 17, whether it's joint ownership of a property.
Perfect. Thank you for that. And thank you, Jeeves, for your input. Rod, I suppose question for yourself, really. I suppose as a landlord and owning quite a few properties, if these changes were brought in, having to get your properties up to EPC rating of C, would you say there'll potentially be a shift in terms of landlords' appetite and what type of properties they're buying moving forward?
Yeah. So my view is, what will a tenant want in 2040, which is, it's a long time off, but by 2040, like the buy-to-lets that I have, I want to own forever and keep and pass on. So by 2040, everybody just about will have an electric car. They've got to be by manufacturers, and all those laws are coming in now. But certainly by 2040, you'll have an electric car, and maybe a lot of the UK population by 2035. So what does the tenant want from the house of the future? I think as a landlord who wants to carry on growing his portfolio, will be, first thing, they're going to want the internet, right? That's a must. Secondly, you will, I think, in the new world, carry on having an element of home working. So having a slightly bigger house footprint with a garden, because we all like access to fresh air. So I'm thinking semi-detached with a driveway with the green charger in. By buying new build, which is my strategy at the moment, you are hedging the fund in the sense of new builds will have what's called a green surplus equity position. In other words, where it was a new build was negative after, once a new build premium goes, it would reduce in value. I see new builds as over the next couple of years accelerating in their value. They are maintained by the builder for 10 years for any really big issues like boilers and structural points. And they're far easier to do maintenance on than your Victorian properties because it's far easier constructed and better to deal with. And I do think you can get an increased rental premium with new build houses, Dan. And I really do think a lot of landlords, remember, most landlords own 1 or 2 properties. And if you've got a house worth 100 grand and you're going to spend 30 grand on it, that might take you 10 to 15 years to claw back in actual profits to get that money back. You're just going to go, I'm going to sell. And that worries me. But what that'll do is drive, there was an article out today in the Times that rent prices are really starting to move up now. As more landlords sell off, I can't buy as many new build properties because they're just not there. But I will then compete down with first time buyers on the new builds, and I potentially may offer more because of the increase in rent. So new build will become much more dominated by landlords. First time buyers are going to be forced to buy those street houses that landlords want to get rid of. And then it ultimately leads those who've got the least amount of money to do the necessary upgrades. And it's kind of passing that baton down. And we need to think about that, Dan.
So on that as well, new build may be a hot topic for landlords and stuff, but where would you personally see the market going on these older properties? Do you see there being a huge difference in terms of value of the same sort of size property, so to speak, same area, but one's on one side of the road where it could be a mid-terrace Victorian house, and on the other side of the road it's a shiny new build? Do you see a huge difference and deficit in terms of value from the older property, which may be EPC-E, versus the new one, which could be a B or a C or well, even an A? And then if we get rid of the terminology of EPC ratings, but we actually look at how many tons of CO2 is emitted from a house, a Victorian house, which is rubbish EPC ratings, and new build, actually, if you look at the amount of tons of CO2 emitted, a new build will issue far more than an unfriendly EPC rated Victorian. So that in itself is a bit of madness. What I do think is, if you've got, and at the moment tenants are not moving on, Dan, you know that with your portfolio, tenants are not moving on, they are staying put. So statistically, they just don't move on. Statistically, they'll be with us to 2028. Technology will have improved it beyond imagination by that time. And the ability to retrofit, the most controversial thing on a retrofit, I think more than the money, is that internal wall insulation. And how can we find a solution that doesn't detract from that family's living space, and without one of those massive water tanks because you've took out the airing cupboard? So I think once we get the facts, and as technology moves on, and any smart landlord would wait until around 2024 before they look to do a retrofit, because technology will have advanced, the supply chain will have increased, costs of material will reduce. At the moment, to doing any refurb, we're on with 2 at the moment, and cost of materials are spiraling, cost of labour spiraling, but it will settle because we've had a boom in extensions and renovations to properties, and we've had COVID and supply chain issues. What will happen is it will settle and it will move. But at the moment, there's a lot of competition for quality builders as house builders want to expand. You've got an expansion in shared ownership, which is against new build, and people wanting to extend properties. This will settle, but there is a challenge if we need to get a skill set of people to help retrofit the properties. But we're just going to have to see. But a lot of landlords with a lot of properties will start buying new build now. That's certainly what I've done. Okay, perfect. If not, we'll just all go to the moon with Elon Musk. Right, another question came in from Ian Clark, so thank you for this, Roger. It's I suppose it's aimed at you. So in light of your comments, will more landlords move to SCL or holiday lets, or hypothetically, will legislation have a similar impact on those properties?
Do you know, Ian, I love you. I love your intelligence, and that is such an incredibly well thought out question, just because not everybody is at your level of knowledge. When we had the introduction to the EPC legislation, which was amended from that section in 2007 from the 2004 Housing Act that became law in April 2018, the exemption was with a property that is classed in your head as a buy-to-let. The exemption for having that EPC E-rating was a holiday let, as long as the property was rented to a landlord and to a tenant on that short-term basis, and they didn't pay for services. So you've got a property in Whitby or Salcombe, and I'm going to rent it for a week, and it's £1,000. That's all I have to pay. I can have the electric, the gas on, and away we go. Me and Dan have often rented holiday properties. So what Ian's alluding to, and again, Ian, this is brilliant, and it's why London has the highest amount of properties on a short-term let basis. It's about 1 in 40, because a property in London that's on a short-term let basis doesn't have to worry about the electrical certificates and the EPC certificates, and it doesn't have to come under legislation for eviction. It can really circumvent those rules. And a holiday let in Salcombe or Whitby, it comes under just a different set of rules. So will the government carry on giving those exemptions? I'm certainly looking to see that, because, Ian, if that happens, substantially more landlords through the landlord groups will advocate to move the properties onto a short-term let basis. And it's for those reasons. So I think that's a brilliant question. And I think that's one, once we get the rules, would be the first thing or the second thing that you and I would look at, because it's what's the rating, what's the exemption, and what's the maximum investment in a property. They're the three things that I would look at. So really good question from me and Dan.
Oh, brilliant. Perfect. And thank you for covering that off. And John, another one's, I suppose, came in for yourself as well. So what questions, if any, are you getting from any property owners in relation to tax about the potential changes that are coming in? Similar to the one that we had, obviously, we're not getting many questions coming to us at the moment around green mortgages, but are you getting any questions from your clients in relation to their portfolios and these new changes which may be coming in?
I'm getting very little noise about that. I would say, and it relates back to your question earlier about what sort of properties are going, what landlords might do. There's a lot more landlords who are developing properties to then ultimately rent out.
By developing, do you mean land purchases and
building property which they will then retain,
okay,
refinance, and then let out on a long-term let, keeping it as an investment? You need to think really, really carefully about that in terms of the tax planning. A new build that is built and sold is a trading item that you can recover all your VAT on. If you are building it and retaining it, you can't. So you need to look really carefully at the structure you have in place in order to do that. It's easier as a new build to put the relevant technology in and meet all the requirements than it is to start with an existing property. The other thing that's probably worth mentioning is empty properties. So if you refurb an empty property, you can get your contractors to charge a 5% rate of VAT, but you've got to meet certain conditions to do that, and you've got to have certain proof in place, and the onus, if it all goes horribly wrong, is on the contractor. So they will only do that if you've got the proper documentation in place. I guess,
but John, I'm asking, everyone will be asking, what does it mean empty? Because it's like the tenant's gone.
Hasn't been lived in for 2 years. Oh,
wow. Okay.
Yeah, hasn't been lived. There's also certain commercial to residential conversions you can do that attract a 5% rate of VAT. It's a very, very, very technical area of the tax legislation, this, and you absolutely should. Sometimes people, we said this before, but on this particular thing, you absolutely should get advice on what it means prior to starting that kind of thing, because it can go very, very wrong and can be very expensive. If you've got a budget to build and then have to slap on another 20%, it could be, and in terms of your lending as well, and the values of your properties and that kind of thing.
Well, we're seeing a shift at the moment in quite a few, not even landlords currently, but they're actually purchasing some land or own land in the building with relaxation of planning in certain areas, etc. And then they're retaining the buy-to-lets. Now you're saying obviously on that basis, and they're not able to make or claim any of that back because they're retaining that property.
Correct.
Could you potentially set up a company that's going to purchase the land, build it, and then sell it to another limited company, claim it back? Obviously, you can have stamp duty or payable on the new purchase, but could that potentially be a beneficial way of doing it?
Potentially, you've got to look at it really closely. But yes, you can. And then there's other arrangements whereby some people will build properties up to the first brick level and then have a sale at that point. That can work in certain circumstances to recover an element of the VAT.
Okay.
And property development companies and property investment companies, development being the building and investment being the retaining and letting out, have very different tax treatments and accounting treatments as well. And as I say, it's a really complicated area. A property developer treats those assets as stock, and you're selling them to make a trading profit. A property investment, you hold that asset for capital gains purposes. Yeah. If you decide, and this is a horrible thing, if you decide as a property developer to retain the asset, you move it from stock to your fixed asset, and the tax on the market value is due, despite the fact you've not sold it. So you really need some very, very careful planning if you are looking. And there's a big, I do a deal with, I mean, I'm in Manchester. I don't know if anybody's seen Manchester at the moment. It's gone nuts in terms of its property development.
Yeah.
And buy to let. We have vertical cities and towns being built around the city centre. There's a development just been put in that holds the same amount of people as a town called Alderley Edge, one of our larger suburban towns. Yeah, and that is the way this particular area is going. It's incredible, but you do need, in that there are smaller people taking smaller pockets of land and building some houses and then retaining them and letting them out. It can go very wrong and can throw up unexpected costs if you don't do it properly.
There you go. Again, that's information that, well, I certainly wasn't aware of, and Rog may or may not have been. But yeah, it just goes to show that using someone like yourself, there's huge value in it. Obviously, it's not free, it comes at a cost. But you know what? If you're saving them money in the long term and you're actually planning the right process for purchase and then offloading, etc., then yeah, there's a huge benefit there. So as always,
it is one of the areas where some early advice can save you a fortune.
That's it. But a lot of people think, oh, well, I don't want to pay for that advice because it might cost me X amount. But actually, Y is 10 times more, isn't it? So it's just about, it's just about getting that right advice. But no, you're right in Manchester in terms of the current developments, because we've just funded a development there, which is just completed. I can't remember what street it's on. I want to say Cannon Street.
Yeah.
Big block of apartments, 247 apartments. But the funny thing is, 244 of those are being purchased by overseas investors from 18 different countries. A lot of them aren't even going to use them. We're going to get the capital growth, and only 3 are purchased by UK investors putting tenants in. So actually, do you know what? Out of that block of apartments, there's probably only going to be 1, if any, owner occupied, which is just phenomenal. And it's just showing the way the landscape's changing for investors these days. So yeah, very, very interesting. Is there any more questions that want to come in at the moment before we start wrapping this up? Because I'm conscious that we are nearly at an hour. But have you got anything else to add, guys, in terms of any more points on this, or is it just a case of, look, we'll see what happens, we'll see what's voted and what comes into place, and then we can kind of plan from there and put maybe something in place to help brokers alike?
Yeah, I would say, David, I know you're listening behind our marketing guru. I would make an emphasis on the next webinar that we'll do another update on the EPC ESG strategy of the UK government and how that affects initially landlords and that wider market. So I think if you could put that in the marketing message, because I think by then, Dan, we'll have some more substantial information, I hope. But I just think really at this moment in time, everything you can do this year is about client contact, the amount of times that you need to be in your clients. We've got 3 interest rate rises expected this year. We've had the first, expect to be 2 more. And even if they don't occur, your client's got questions and you need to be in front of them. And remember, there's different options you can give your customer. So that would be my point. John, you'll always have a better point than me.
It's not in my mind. It's just to drive home an earlier point. Tax changes, tax reliefs are not retrospective. So despite a lot of noise, and I spend my life around noise on tax changes, they don't occur until it's law. So there is little, unless you have a personal agenda of wanting to be particularly environmentally friendly in relation to your properties and have the means to do so, it is very much worth waiting till the facts are known and the law has changed.
Yeah, no, absolutely. Thank you for that. And I think for me, it's just about having as many tools in your toolbox, really. So I'm not telling you to swallow Google like Rog has, but educate yourself around the market, the changes, have contacts in places where you know you can go. So you've got a tax advisor like John, you've got a master broker like ourselves, solicitors, you name it. So you've got those in your arsenal. So when something does arise, then you can go to an expert, which in an area you may not be particularly confident about or have much knowledge. And it's just about having a team behind you, which builds your brand and your business, and you can add value, because your days of just doing mortgages, that's well gone now. You've got to have many hats on when you're having your conversations and do the full holistic review, really. As much as you're not qualified in every area, and you need to, I suppose, caveat that and mention it, they're going to ask you questions. And if you have a base of education on each kind of topic area, then it's going to help you hugely in your business, really. So that's what I will say, just educate yourself around everything that's changing. And you know what? We're focusing on this over here. There's going to be some sort of Trojan horse or something coming at us from the other side. It's always the case in this. And again, we're going to be ready to counter that. So I think that pretty much wraps it up, to be honest, guys. So thank you very much for coming on. It's been hugely beneficial as always. We've got another webinar in 2 months' time. So we're actually doing these bi-monthly now, just so we've got lots of content to discuss. And again, a lot of people are now getting back out face-to-face, going to physical events, which is amazing. So we'll probably see quite a few there over the coming months. But honestly, get in touch with myself if you want to speak around cases. All of our contact details are sent after this. If you've got something you want to discuss with John, then John's email address will be on there. You can email John and hopefully work together. And yeah, thank you very much for joining. Hope you all have a great day. Gents, thanks for coming on. As always, it's been a very informative session, and I hope to see you all soon.
Thank you.
Thanks on all the messages in the chat, guys. Ian, Rory, there's so many, and my eyesight isn't so good. Thank you all. And please remember, your specialist partner when it comes to mortgages and everything to do with it is Crystal Specialist Finance. Have a wonderful day.
Thank you. Over and out. Bye-bye.